Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for onerous contract, or what we call loss-making contract, under IAS 37 provisions, contingent liabilities, and contingent assets. Now let's look at this question. Start with the requirement. Show how much provision ABC should account for as at 31st December 20x9. ABC's year-end is 31st December 20x9. ABC decided to enter into a new lease agreement for the use of an office building which has a larger office space. So there's a new lease. ABC had existing lease agreement with 2 years remaining. So it means that there is an existing lease agreement, and by the year end, they have entered into a new lease agreement. The outstanding lease obligation on the lease at the end of the year is 1.2 million. Remember, this is an obligation. ABC had an option to terminate the contract for 0.9 at the current year end. Now, what it is that because they have a new lease agreement, the old lease agreement would become a loss-making agreement. So they have two options: to allow the 2 years to expire or terminate the contract. So the criteria to use to establish the fact that there should be a provision is that we have to ask ourselves, is it a present obligation? And the answer is yes, there is a present obligation, because at the year end they have a lease obligation to account for, a lease obligation of 1.2 million. So there is an obligation. Now, because it's an onerous contract, which is a loss-making contract, the measurement of the provision is that, as per the IAS 37, it should be the lower of the cost to fulfill the contract or terminate the contract. Now, based on the details of the question, the most rational course of action ABC would take would be to take the lower option, which is to terminate the contract and have an obligation of 0.9, instead of allowing the contract to expire and incur a higher cost of 1.2 million. So therefore, at a year end, the provision that ABC should make should be to debit profit or loss, which is 0.9 million, and credit provision 0.9 million. So the provision to be made at a year end for this onerous contract is that the entity ABC should account for the lower of the two costs, which makes sense, which make business sense. So in the disclosures, they would have to disclose the details of these contract and the course of action taken and how they have gone in accordance with the standard IAS 37. I hope this helps you in your preparation for the FR exam. Please subscribe to this channel to receive updates on new videos.